Hello, everybody. This is Ed Yardeni with Oscar. Let me just fix the computer here. My mother-in-law gone off to Paris and India for 3 weeks. So we got Oscar. So we're babysitting for Oscar. We got our own 3 dogs, and then Oscar kind of runs around and annoys the 3 of them. But generally speaking, a pretty good boy. So he just says hello, and we'll set him free so he can go wherever he likes. All right. He's actually a city dog. She lives in the city, in New York City, and he always gets very excited when he can roam around the house here and have a good time. Anyways, let's talk about things. Well, I always start out by telling you about the weather in Long Island. I don't know why I started doing that, but here in Long Island, it's been cold. But as you can probably tell from the lighting in the room, it's once again very sunny as it was last week. And like I said last week, it was a sunny week for the stock market 2 weeks ago. And then, of course, this past week wasn't so bad either. We're basically up over 7% since we made the low on October 27th. So the market didn't get spooked by Halloween. It did quite well before Halloween. I think the Santa Claus rally has already started. I think it started back in October 27th. Usually it starts after Halloween. It starts closer to Thanksgiving, but this time around it seems to be occurring early. We did have a pretty nasty correction, but it was a fairly typical correction, a little over 10% from August, from July 31st through October 27th. So that was a very traditional kind of correction. So far, this bull market, which I think it still is, has turned out to be a fairly traditional bull market. This is the 3rd year of a presidential term, and 3rd years of presidential terms tend to be the best of the 4. So far, so good. We started out with a very strong January barometer. I don't know if you can recall, but we were up by over 6% in January. Not bad for 1 month of return. And then, of course, it kept going through July 31st of this year. And then we made a top at that point. Then we had our correction through October 27th. So all fairly traditional. We had our traditional bad month of September, and October can be mixed, but when it's not going well, it goes really badly. And so September and October were bad months, but here we are in November, and we're doing pretty well. There did seem to be something magical about starting this month on November 1st. That was when Powell gave his press conference for the latest FOMC meeting, and he sounded, well, the markets read him as being a little less hawkish, not necessarily dovish, but a little less hawkish, meaning that maybe the Fed isn't going to raise interest rates anymore, but they're going to remain hawkish in terms of keeping interest rates higher for longer and being restrictive. Getting a lot of questions these days about, okay, when are rates going to come down, and how much are they going to fall next year? I really don't have a problem if rates just stay here. I think the economy has demonstrated that it's resilient. We've seen short-term rates and long-term rates rise by over 500 basis points, and that obviously freaked out a lot of the pessimists, the perma bears, into predicting that this would end rather badly. They thought we'd have a recession in 2022 when interest rates first started going up. And then, of course, we had the Ukraine-Russian situation and the impact that had on inflation. When it didn't happen in 2022, in early 2023, there was a lot of talk about a recession in the first half of the year and a bad stock market in the first half, followed by a better stock market in the second half. And so far, it's kind of been the reverse of that, where we've had a really good stock market in the first half. And I think we're going to go back to 4,600, which would actually be a new high for the year. But we essentially got up to 4,600 on July 31st. So that would be consolidating our gains from the first half would be acceptable, I would think. And then I think we could very well be setting the stage for moving still higher next year. And as you know, I'm still talking about 5,400. I can see that Oscar's in the background there sniffing around. So that's kind of the way it looks to me. The economy still looks like it's proceeding according to our on course for a soft landing. It didn't look like much of a soft landing during the third quarter. We had real GDP up 4.9%. There's something called non-farm business output, which is what's used to measure productivity. That was up by almost 6%. So we had a really strong third quarter. Kind of don't expect that to be sustainable. Expect to be back to 2.5% growth. As a matter of fact, the Atlanta Fed's GDP now forecasting model is currently tracking the fourth quarter at a rate of about 2.4% at an annual rate. So that's kind of back to something a little bit cooler. The labor market seems to have cooled off in October, but let's not forget there was a UAW strike that cost 33,000 workers from the payroll accounts. On the other hand, some of the strength was related to 50,000 employees in the government. I think a lot of it was just at this state and local level, particularly education. And so, I mean, that counts. Those are real jobs. But in terms of the underlying employment of the private sector, things look like they've gotten so much weaker, which would be welcome because that's what the Fed has been rooting for. I've come to the conclusion that growth is good. I've always believed that growth is good if it's based on productivity, and I still think that we are in the I don't even know if it's the early stages of a productivity growth boom. And as I've said before, productivity growth boom made its low in late 2015. And back then, the productivity number was 0.5%. Now we're saying that number went up to 1.5% right before the pandemic. So then the pandemic hit and everything was all messed up. But now we're back to 1.7% in productivity growth. And I'm using a 20-quarter annualized number just to get at the underlying trend in productivity because it can be quite volatile quarter to quarter. I still think we're going to go to 3.5%, 4.5% in this productivity growth boom through the end of this decade. So hence, I'm not giving up on the idea that this will turn out to be the roaring 2020s. Meanwhile, for the here and now, let's have a look at some charts that are relevant to this particular discussion. Oh, by the way, I should remember, I don't know yet. I don't know if I'm going to do another call a week from now. Going to go take a little vacation with my wife and one of my kids and her boyfriend. We're going to go to St. Martin. So I expect to be sitting on the beach vegging out. So unless something really crazy happens, in which case I may record something in advance. But I don't know. I kind of got you to like doing this and visiting with you guys on a regular weekly basis. So we'll see how that goes. But for now, I'll probably send out a message one way or the other. So let's go to the videotape, as Warner Wolf once said. And let's share. Okay, so this is our charts. And as I've been saying the past few weeks, we are actually transitioning pretty quickly from the old charts to the new chart program. And that's pretty neat. In the old chart program, I was clueless about how to operate it. So I kind of depended on everybody else in our team to do it. And they did a great job. But now I don't have to annoy them as often. I can actually play with these things and have some fun. It's actually become a bit of a distraction. So, for example, if you're looking at figure one, I spent some time playing amateur technician, and I drew this trend line. I think Jeff Gundlach was on CNBC actually on November 1st and mentioned it, and I said, I don't know how I missed it. Well, the reason I missed it is because my chart was kind of focused on, I think it started in 2021, so it didn't catch the 2020 picture. But it's worth looking at. And so you can see that we slice through the 200-day moving average and exactly found support at that trend line. Now, just for fun, I came up with another trend line all on my own without Jeff's assistance this time. And I don't know, it's just, I think technical analysis makes sense. It's sort of a psychological tool. It's, when the market gets bad news, where might it, how far down might it discount that bad news? Where might it kind of find some support to reassess whether the bad news is sustainable or not? And so it found that support here. And now the question is, if we just keep shooting up here to, let's say, 45.50, then we will be testing this trend line. If we actually get to 4,600 by the end of the year, that would put it slightly above this trend line and would set us up for a nice breakout into early next year. Now, why might that happen? Well, the market might conclude that the Fed really is done tightening and that the bond yield really, the Bond Vigilantes are perfectly satisfied with 4.5%, 5%. And why would they be satisfied with that when the deficit and debt problems are still huge? And well, the answer might be that inflation will moderate surprisingly well, which I think it is doing so. But I'm not saying that the deficit and the debt problems have gone away. They're still very much with us, but we all know that there's not much, there's nothing that really can be done about it from a political standpoint between now and the elections. There's nothing going to happen. So I think the markets are willing to bide some time here on that particular issue and focus on some others, which is why a good enough explanation for how it is that we went from 5% to 4.6%, really 4.5% in a heartbeat a couple of weeks ago, without anything substantial happening to improve the outlook for the deficit and the debt. This just shows the S&P 500. Let me put it a little higher here. This just shows the S&P 500 going back to the late 60s and versus recession shades. This S&P 500 has had a pretty good, been pretty useful in predicting recessions. It is one of the 10 components of the index of leading economic indicators, and it's mostly gotten them right. I think there was a downturn here in 1986, which there was no recession. The economy continued to perform quite well. So it's not flawless. And just because something's worked for 8, 9, 10 times doesn't mean it's not overdue to be wrong. And I think that's the case in this situation. The stock market had a significant bear market, but a traditional one, 25%, and it didn't really last that long. It lasted from this beginning of 2022 to when was it? October 12th. And so we bottomed there, and we've had this rally here. I guess you could still argue, if you're a pessimist, that we're not out of the woods yet. It could still turn out to be a continuation of this bear market, and it's certainly had that potential when it got to that uptrend line. And if it crashed through it, the bears would have been all over this, saying, "See, we told you so." This was all a fake rally here. It was just led by the mega cap 8, and it wasn't broad enough. But just because something's not broad enough right now doesn't mean it can't broaden out. And that's what I'm expecting we'll see as we go into 2024 and beyond. But no recession this year, as it turns out, and no recession next year, though I'm a reasonable fellow. I'm willing to put some sort of subjective odds in a recession, and it's not insignificant at 35%. But some of that reflects my concerns about what's going on in the Middle East. And that situation seems to still be a fairly direct war between Israel and Hamas. Let me just turn this off. Seems to be a direct confrontation between Israel and Hamas, and hasn't spread into a regional war, but it certainly looks like it could. Things are heating up, according to, I think it was the Wall Street Journal or one of the outlets this morning said that Israeli generals are saying that things, they're getting attacked too often up there in the north in these skirmishes, and that if it doesn't stop, it's going to be a war up there with Lebanon. And then, of course, while the U.S. has taken out some facilities of the surrogates of Iran in Iraq and Syria, they're still up to their old ways. They're still bombing American military facilities, and there have been some injuries. As I think, maybe I'm wrong about that. I withdraw that because I don't know for sure. But I think the U.S. has indicated that if Americans are in fact hit, they would we would have to escalate our response here. But the Iranians certainly haven't called off the dogs of war on their side. So it's still a dangerous situation, though you wouldn't know it looking at the price of oil. We'll have some more write-ups on the price of oil, looking at the fact that oil production in the U.S. Just rose to an all-time record high of 13.2 million barrels per day. And the increase in oil prices, gasoline prices during the summer actually led to a response by American consumers to cut back. I pointed out that one of the things that's changed since the pandemic, as we all know, and as we've known, as I've known for a while, where people are working from home. Our firm's been virtual since 2007. So I've been telling everybody, welcome to our world. I never understood the concept of commuting, given what we do for a living. And we stay very much in touch with the Yardeni research team. And so that model's worked pretty well for us, and it's working for a lot of other people. I have been traveling around visiting with accounts, but I find one of the things that happens is when I go into their conference rooms, there aren't that many people in the conference rooms. There are a lot of people that call in on Zoom. So kind of I scratched my head and said, so why don't I just stay home and do this by Zoom? Well, the answer is I like to visit with people. You can schmooze better and get an idea of what's going on in the real world. Let's move on here. So what freaked the perma bears out is, of course, interest rates soaring in 2022 and through 2023. Here's the Fed funds rate. Here's a longer view of the Fed funds rate, and you can see that it's up by over 500 basis points. And you can see that previous periods when we had this rapid increases in interest rates, we would get a recession. And so far, so good. So far, we haven't had that happen. And I think, as we've discussed many times before, the economy has been going through a rolling recession. The economy overall has been remarkably resilient, as proven by the way it's performed. I've been saying that so far everything's kind of benefit of hindsight. Obviously, everything's worked out in a fairly classic fashion. We had a classic bear market followed by a bull market, and so far the bull market this year has followed a lot of the technical patterns and the calendar patterns of the past. Benefit of hindsight, too bad we didn't all see this coming, but the bond yield bottomed at 0.5% roughly back in the summer of 2020. And then we've been in a terrible bear market for bonds, but I think it's may very well be over already. It was terrible, but it lasted 3 years. I don't think it's going to last as long as the bull market lasted. And as soon as the Fed stopped putting a noose around the bond vigilantes, they were free to price the bonds as was appropriate, especially given inflation and the Fed's response with short-term rates. And so we zoomed up, not straight up, but almost straight up to 5%. Found support there. Bill Ackman had a great trade, sold right there at 5%, and now we're back down to here. I guess there's still going to be people talking about 6-7%, but that's not what I think is going to happen. I think we're basically back to the old normal of 4 or 5% bond yields, which is what we had before the abnormality we had between the great financial crisis and the great virus crisis. Here's a chart relevant to the stock market. The market's doing better because earnings are still, expectations are going up, and I'm talking about forward earnings expectations, analyst consensus expectations for this year and next year on a time-weighted average basis. But as you can see, there's somewhat, not perfect, but somewhat inverse relationship between the bond yield and the forward PE. And if the bond yield just stabilizes here for a while, which is our story, we're not seeing it taking a big dive here, nor going up above 5%, then the forward PE may start to stabilize here, and it still leaves it high at around 18. But let's not forget that 27% of the S&P 500's market cap is now attributable to the mega cap 8, and they are highly priced. They have high valuation multiples, and doesn't look like that's going to change anytime soon. Here's the yield curve spread that spooked a lot of investors out, that it's got a fabulous record of forecasting recessions. Well, so far it hasn't worked. Again, there's still some odds here and that a recession could happen next year, but it hasn't worked so far. And meanwhile, the disinversion of the yield curve has been noted by some of the bears as saying, well, recessions happen after the yield curve disinverts. Well, when you really look at this in a historical context, what you see is that the yield curve inverts as investors perceive that if the Fed keeps raising short-term interest rates, something will break. And so bond yields stop rising as rapidly as short-term rates. And then something breaks. And what happens then, of course, is that the Fed realizes that they've overdone it. They've start to lower interest rates. Meanwhile, the fact that something breaks causes a credit crunch and a recession. So that kind of gets locked in. But the Fed responds pretty quickly by lowering short-term interest rates, and faster than bond yields fall. In this situation, bond yields rose faster than short-term rates. Bond yields rose faster than short-term rates rose. So it's an oddball. The market, I think, also there at the tail end of the correction was concerned about the oil price going down. Obviously, that weighed down the energy sector. But the concern was maybe the global economy is a lot weaker than we recognize. We know that China's got some major structural issues with their property market. Europe's in a mild recession right now. Could always get worse, but there's not much signs that it's going to get better. But this recent uptick the past couple of days, maybe that's just a short-term response. These things never go in straight lines. But if the global economy is weak, but not that weak, we should be finding some support here in the oil price, and that may also help the stock market. Meanwhile, as I said, the deficit problem hasn't gone away. The debt problem hasn't gone away. This is the net interest payments. We've looked at that before. We'll pass on it again. We'll pass on this one that just shows you that marketable treasury securities all-time record high of $26 trillion. Let's talk about the here and now. Tomorrow's the CPI, and it's conceivable that all this happy talk that we've enjoyed and happy move in the stock market we've enjoyed and bond market for the past couple of weeks, that'll all be blown away by higher than expected inflation and or weaker than expected economic growth. Here's I think a nifty chart, and again it's become sort of a hobby here to play with these charts because I can really have some more quality time with the data. And so I put this chart together. We've had variations of it, but it's kind of interesting. If you take the CPI for gasoline and divide it by 100, you get something that actually looks like the price of gasoline on a chart anyways, and dollars per gallon. So that's the red line here. And you can see that we had an increase in the price of gasoline in the CPI, which is of course consistent with the green line here, which is gasoline nearby futures daily, and the retail weekly. The green line is the retail weekly, and this is the futures. So everybody knows this. We know that the price of gasoline came down both in terms of the retail price and the futures price, and so this is going to take a decline. I think we're going to continue to see rent inflation moderating, and if that's the case, then everybody's talking about a increase of zero. What are they talking about? 0.01. So 0.01% increase in the month over month in the headline, and a 0.03% increase in the month over month increase for the CPI headline core, I should say. So I think this will just be consistent with the inflation continuing to show moderation. I think maybe that was 0.1 and 0.3. Anyways, don't quote me. Now, retail sales comes out this week. Industrial productions come out this week, and the payroll employment numbers all suggest that they might be on the weak side. Retail sales, of course, is for good merchandise goods. We know that consumers have pivoted around to services. They're traveling a lot. They're going to Taylor Swift concerts and so on. And it's possible that retail sales might be weak, even though consumers are still spending. They're just continuing to spend on services. But I think the markets would clearly like to see some slowing in the economy. 2.5% growth in real GDP is fine, which is essentially what we're doing right now. Consumer credit came out last week, and that was on the weak side, and that was for September. And yet September was a pretty strong month for retail sales. So you can't really do much with the consumer credit to forecast the economy. And this idea that consumers are borrowing at 22% interest rates, most people, I think the vast majority of people use credit cards just for convenience. They're not borrowing to maintain their spending. And finally, this is industrial production and manufacturing, and the hours worked versus the actual production index, and it may very well be a slight negative number. So it's conceivable that next week, I think it's on Monday, we're going to have the index of coincident economic indicators and leading economic indicators. Leading economic indicators have been weak since December 2021. So it's just been dead wrong so far, but who knows? Maybe it'll be right. I don't think so. But meanwhile, the index of coincident economic indicators, which is really the best monthly way to gauge whether we're growing or falling into recession, that may actually decline for the first time in quite some time. But it usually takes 3 consecutive monthly declines for economists like myself to start to conclude that maybe this is really giving us a heads up that we're in a recession already. So that's a few things to cover. Let's go to the questions here. Okay. Okay, so all I got to do is show the dogs. Everybody seems to like the dogs. Okay. Willem, nice to hear from you. Moody's last Friday lowered its assessment of the U.S. federal government credit outlook from stable to negative. Do you expect to see more reassessments like this? Could it adversely affect economy-wide credit conditions? This is a very good question. Look, it's a known. Fitch Ratings downgraded the debt from AAA to AA plus, and they did that on August 1st. And I think that was one of the factors that contributed to the correction in the stock market and this continued sell-off in the bond market. So Moody's telling us that there's a problem just confirms what Fitch has been telling us, and Fitch didn't tell us anything we didn't know. It's just that nobody really seemed to care much about it. The bond market never seemed to care about supply until Fitch reminded us that this thing's getting uglier and uglier, and suddenly the bond market cared about that quite a bit. Interestingly, Janet Yellen was interviewed, I think, in mid-October about the sell-off in the bond market, and Janet said, I'm on first-name basis with her, and not because I know her or I think we met once, but we both went to Yale, and she went to study under Tobin 6 years before I did, and I studied from her notes that were Xeroxed by everybody to get through Tobin's class. So anyways, Janet Yellen said that supply isn't the problem. That's not what's driving bond yields higher. And she pointed out that, other countries don't have as big a deficit, and those yields have gone up as well. And I would beg to differ, pointing out that maybe they don't have the same deficit problems we have, but our deficit problem is big enough for the entire world. And if our bond yields are going up, guess what they're going to do overseas? So I really didn't buy that argument. But she seems to be still in that la-la land of modern monetary theory that the government could just borrow with abandon and it just owes it to itself. So what's the difference? But interestingly, on Wednesday of last week, did you notice that when the Treasury announced the auctions, they cut back on notes and bonds. They cut back on the supply, and that's one of the reasons that the bond market rallied on that. Is the bond market figures, hey, if we can get the Treasury to fund all of this in the bill market, then we can live with this. But I thought that was kind of an interesting development. But no, I don't know. I, I it's conceivable that the bond vigilantes will come back, and we'll see the bond yields go to 6-7%. But there's so many moving parts in this story that I don't know that this is going to trigger a credit event. Maybe corporate bonds and junk bonds should be viewed more favorably, given that the U.S. government's credit isn't as pure as it had been. Anyways, Willem, I don't know if that answers your question, but that's the best I can do right now. Okay, so you said that you think the economy will be okay if interest rates stay at these levels. Some other economic analysts think that we're still due for a recession because they say you have to pay attention to M2 and consumers spending down their savings. What are your thoughts? This would take a couple of hours. I've been writing about this for quite some time. The short answer is excess savings is still a possible. If we get a really weak retail sales, guess what? Everybody's going to start to say, see, we told you so. The pessimists will say, we told you so. The consumers have run out of excess savings. And I'll still be kind of out there, maybe lamely saying, well, wait a second, the baby boomers have $75 trillion in net worth that they're increasingly spending and saving less as they're retiring. So we'll see how that one plays out. M2, I mean, if you look at the components of M2, you can't look at the growth rate because you have to realize that the growth rate has turned negative because it was absolutely soaring during the pandemic. So year-over-year comparisons are always going to do that. You look at the levels, and there's a tremendous amount of liquidity in money market funds and demand deposits of all places. Okay. Do you think what is going on in Congress with the budget will send the markets down sharply? Nah. Look, my attitude, my glib attitude towards Washington is look how well America keeps doing despite Washington. And that's not to say that they can't do things that'll screw up our economy, but they've done plenty of that. But there's a lot of people like you and me that get up in the morning and we work for a living and we try to make things better for ourselves, our families, our communities, country. And I think there's enough of us to keep things going. So as hard as they try, I think we'll continue to see the economy perform remarkably well. Happy vacation and Thanksgiving from John. And that's to me and to all of you, I presume. I'll take one more question here. Jay Powell has said during the summer meeting that if the economy behaves like what they expect it to, then they will need to increase the rates twice. No media seems to have picked up on what are your thoughts? Yeah, I mean, there's still a rate hike in play for this year, but I think what people read into his last commentary, his press conference especially, on November 1st, is that maybe not if let's see what the CPI and retail sales numbers look like, then ask me again. But if they're on the weak side, then I don't think we're going to get another hike in the Fed funds rate. Of course, one of the reasons they didn't hike is because the bond yield jumped to 5%, and now that's down to 4.5%. Maybe that's taken some of the tightening out of the market. And of course, the stock market rally is also another financial condition that's loosened up. But anyways, that's it. So look, thanks very much. If we don't get together next week, have a great Thanksgiving. It's got to be the best holiday of them all, to get together with family and friends and eat yourself silly. So eat yourself silly, get together with your friends and family, have a great time, stay healthy, and enjoy the Santa Claus rally. I think it'll continue. Thank you.